The United States just ordered JPMorgan and Bank of America to walk away from a Chinese IPO, not in Shanghai, but in Hong Kong. Within 72 hours, China started quietly offloading billions in U.S. debt. No headlines, no handshakes, just cold, calculated exits. While Wall Street scrambled for cover, Beijing didn't raise its voice. It moved its money. And beneath that silence, a storm is brewing. Because what's unfolding isn't a diplomatic freeze or a trade dispute, it's a controlled detonation at the center of the global financial system. On March 27, 2025, U.S. officials issued direct warnings to JPMorgan and Bank of America over their underwriting roles in a $1.1 billion IPO by Green Tech Systems, a state-backed Chinese AI chipmaker listing on the Hong Kong Stock Exchange. The IPO had already secured institutional interest across Asia, but after the National Security Council flagged the deal as strategically misaligned with U.S. interests, both banks abruptly pulled out within 48 hours. According to the Financial Times, the withdrawal shaved nearly $210 million off the company's opening valuation. What makes this move extraordinary is its jurisdictional reach. Washington is exerting financial control over a deal outside its own borders. Georgetown's Center for Security and Emerging Technology called the act a form of extraterritorial capital deterrence, one that signals to U.S. banks align your portfolio with national security or get pushed out of global finance. But is this tactical containment, or is the United States writing itself out of the most dynamic financial region on Earth? As of February 2025, China's total exposure to U.S. assets, when including treasuries, agency bonds, equities, and corporate holdings, stands at $1.67 trillion, according to Morgan Stanley. While a rapid liquidation would destabilize both economies, Beijing's shift is already underway. The latest TIC data shows China cut its treasury holdings by $78.5 billion in Q1 2025. The sharpest quarterly reduction since 2016. Barclays head of macro strategy, Ajay Rajan, notes, "This is not a tantrum. It's a measured diversification strategy designed to minimize dependency." Bloomberg reports that these funds are being reallocated to yuan-denominated assets, BRICS, infrastructure debt, and gold reserves. If this gradual unwind accelerates, the Federal Reserve could face higher borrowing costs as demand for U.S. debt declines, putting pressure on both domestic interest rates and the dollar's global standing. But what happens if Congress pushes the next domino first? In April 2025, the Senate Banking Committee advanced a bipartisan bill mandating that U.S. institutional investors, including pension funds and index managers, divest from over 220 Chinese companies classified as strategically sensitive. According to Bloomberg Intelligence, these companies represent roughly $812 billion in U.S.-linked capital across public and private markets. BlackRock alone manages $115 billion in Chinese assets that would fall under scrutiny. Goldman Sachs's Asia Equity Desk warns that forced liquidation would trigger a chain reaction of market distortion, especially across passive funds and ADR-linked ETFs. Worse, the New York Stock Exchange and NASDAQ could see over a dozen Chinese firms voluntarily delist in anticipation of legal uncertainty. The bigger question? If American capital is pulled out en masse, can Wall Street maintain relevance in Asia's $34 trillion market? Stop for a second. This wasn't a battlefield Washington ever planned for. It's not Taiwan. It's not the South China Sea. It's Hong Kong, once Wall Street's offshore playground, now a power pivot Beijing controls. Since December 2024, Chinese institutional outflows from U.S. dollar-denominated assets have topped $92 billion, with the majority redirected into Hong Kong equities, Japanese bonds, and physical gold, according to the Bank of International Settlements. A February report from Nomura shows that holdings in Japan's 10-year bonds by Chinese investors jumped 28% in just one quarter, while Shanghai Gold Exchange volumes reached a 5-year high in March. This isn't flight, it's strategy. After U.S. Treasury sanctions on a Chinese drone manufacturer last year, domestic firms began shielding their exposure by routing capital through Hong Kong family offices and offshore trusts. They're not abandoning the dollar, they're building escape hatches, said former PBOC advisor Dr. Chen Zhao. What's emerging is a parallel financial ecosystem, one that still touches U.S. markets, but no longer relies on them. So, if China has already moved its pieces, is anyone still betting on the American board? In the first quarter of 2025, foreign investors sold $317.4 billion in U.S. Treasuries, corporate bonds, and equities, marking the largest single-quarter withdrawal since the global financial crisis, according to Treasury International Capital data. Japan trimmed its Treasury holdings by $19.3 billion, Saudi Arabia by $11.7 billion, and Germany exited over $9 billion. Reuters reports that this wave is less about interest rates and more about geopolitical predictability, namely the weaponization of financial infrastructure. BNP Paribas strategist Daniel Tenenghauser noted that once the U.S. starts intervening in cross-border listings and asset allocations, global capital starts rethinking exposure. The Dow Jones slipped 3.7% in March alone, while bond volatility, as measured by the MOVE Index, hit its highest level since 2020. What's unraveling isn't just a portfolio. It's a narrative that U.S. markets are neutral, safe, and sovereign. If confidence continues to erode, the next capital exit might not be strategic, it might be permanent. But is there any move left that can restore trust before the next round of exits begins? As of April 2025, Beijing has committed $423 billion to domestic financial infrastructure via the Central Financial Commission, targeting fintech, bond underwriting, and cross-border settlement, according to Caixin Global. The China Securities Regulatory Commission recently approved a program to fully replace foreign credit rating dependencies by 2026, aiming to phase out Moody's, Fitch, and S&P from major domestic deals. Meanwhile, the Shanghai International Board, China's alternative to Nasdaq, logged $112 billion in foreign listings this quarter alone, fueled by regional banks from Southeast Asia and the Middle East. Wall Street's exit isn't slowing Beijing. It's accelerating localization, said Daniel H. Rosen of the Rhodium Group. Still, capital controls, limited convertibility, and opaque enforcement remain key barriers. But if China can establish regional liquidity without Western gatekeepers, the conversation will shift from can they survive to can they lead. And that's what has policymakers in Washington, D.C. scrambling to catch up. In the first quarter of 2025, the BRICS Interbank Cooperation Mechanism processed $56.4 billion in cross-border payments, marking a 320% increase from the same period in 2023. According to SWIFT alternative data from the New Development Bank, BRICS countries now clear 48% of their internal trade in local currencies, with Beijing providing 65% of the yuan liquidity. Saudi Arabia's April bond auction, $3 billion priced in yuan, was oversubscribed fourfold, drawing bids from India, Brazil, and Egypt. We're seeing the emergence of a settlement bloc with real teeth, said Dr. Eswar Prasad, former head of the IMF's China division. U.S. banks, constrained by expanding sanctions and regulatory risk, have lost underwriting access to over $70 billion in energy and infrastructure deals within BRICS this year. This isn't about replacing Wall Street globally yet. But for the Global South, the financial center of gravity is already shifting, and that shift might not wait for permission. Between 2020 and 2022, 75% of Asia's IPO proceeds were funneled through U.S. exchanges. As of the first quarter of 2025, that number has collapsed to just 28%, with $103 billion in deals now flowing through Singapore, Hong Kong, and Shanghai, according to EY's latest Asia Capital Markets report. Blackstone and KKR have quietly restructured their Asia funds to domicile in the UAE and Singapore, bypassing U.S. exposure entirely. New York isn't being replaced, it's being sidestepped, said CLSA's managing director, Clara Zhou. Meanwhile, the dollar's share of global forex reserves fell to 57.4%, a 28-year low, according to IMF data released in March. While the dollar remains dominant, erosion at the edges is becoming structural. The message to emerging markets? Financial sovereignty no longer requires Wall Street's blessing. But if the gatekeepers are losing control, who's setting the rules now? As of April 2025, U.S. sanctions impact over 1,400 foreign entities, more than double the count in 2020, according to the Treasury Department's Office of Foreign Assets Control. Each sanction pushes countries to seek alternatives, and Washington's use of financial pressure has backfired in unexpected ways. Weaponizing the dollar shortens its shelf life, warned former Treasury Secretary Larry Summers in a March interview with Bloomberg. On the domestic front, regulatory uncertainty is also spooking investors. The SEC's new cross-border capital rules are delaying or blocking $220 billion in foreign listings, while FDI inflows fell 16.4% year-over-year per Commerce Department data. To reverse this fragmentation, the U.S. would need to reduce its reliance on punitive financial tools, reestablish predictable legal norms, and rebuild trust with both allies and rivals. But even those steps might not fully halt the diversification already in motion. And that raises one final question. What happens when the financial world stops waiting for America to lead? Wall Street thought it had time, that no rival could match its depth, its trust, its liquidity. But time may no longer be the key variable. Velocity is. As China builds faster, BRICS clears wider, and investors hedge deeper, the dollar's dominance is no longer default, it's now a decision. Every IPO that skips New York, every treasury sold by a foreign bank, every trade settled in yuan instead of dollars, that's not noise. It's a signal. A signal that the global financial system is being rewritten, not with press conferences, but with transactions. Drop a comment. Does this mark the end of U.S. financial supremacy? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.